On to YouTube, right back at you with another one. We got some stock picks, some great EV picks today. Just looking at here, we got Bitcoin prices past 32K. I've made some great gains today in Bitcoin, by the way. I don't know what happened. All right. These are just three top dividend stocks I feel like you should buy in January. First one's AWK, American Water. This thing's up 24% over the past year. Decent dividend of 1.40%, $27 billion market cap, and it's still about $22 off its highs. It's got a 87% buy rating from 15 different analysts. American Water's size should be an advantage in pursuing new customers and acquisitions in the coming years. Tuck-ins to existing systems are a cheap source of growth if the price is reasonable. Most of America's water infrastructure is old and will require significant investment over the coming decades, allowing the company to increase its rate base and earning for years to come. Dividend growth should average 10% annually over the next 5 years. They've been killing EPS. This is a water company out of New Jersey, so to give you exposure to the sectors of industrials, water, transportation, and construction services. So basically they engage in the provision of complementary water and waste services. They do regulated businesses, market-based businesses, and other types of businesses. The regulated businesses segment provides water and wastewater services to customers. The market-based business segment is responsible for military service groups, contract operations group, homeowners service group, and keystone operations. The other segments includes corporate costs that are not allocated to the company's operated segments, eliminations of inter-segment transactions, fair value adjustments, and associated income and deductions related to the acquisitions that have not been allocated to the operating segments for evaluation of performance and allocation resource purposes. This company's been around since 1886. So this is a great dividend play here. Second dividend we got is BIP and BIPC. This is basically, I said BIC, I mean BIP and BIPC. This is Brookfield infrastructure companies. Both of these are great dividends. These aren't going to fluctuate very much, so this is basically a safe place to put your money with a 4% dividend yield. Strong buy rating from 14 analysts, and this gives you exposure to energy and industrial sectors. Basically, engage in the management of diversified portfolio of infrastructure assets that will generate sustainable and growing distributions over the long term for unit holders. It does utility, transportation, energy, data infrastructure, and they also have a corporate segment. The utility segment includes the regulation of business, which earns a return on access base. The transportation segment consists in freight, bulk commodities, and passenger. The energy segment comprises systems that give energy transmission, gathering, processing, and storage services. The data infrastructure segment involves in the critical infrastructure and services to global communication companies. And then BIPC, this one here has been up over 87% in the past year. Does not pay a dividend, but it is a great growth stock. It's an energy company out of New York, and it engages in the ownership and operation of infrastructure assets through its subsidiaries. Its businesses include transportation, data infrastructure, and energy. The third great top dividend play for January will be a REIT, WPC. This is something I already own. I'm currently up 7.73%, and I got a dividend that's going to be paying out on the 15th. So it should be ex-dividend around the 14th. So if you get in before then, you can collect that nice dividend yield of 5.91% on this play. This company has been beaten down due to the pandemic. It's up 4% since then, and it's got about another 22% of growth left in it. Strong buy rating of 100%, 38% buy, 68% hold. Great EPS. This is a real estate company out of New York. I swing traded this back in October, and my profits I left in the market in November. So basically, this is a real estate investment trust. It operates through two segments: real estate ownership and investment management. The real estate ownership segment owns and invests in commercial real estate properties. The investment management segment structures and negotiates investments and debit placement transactions for real estate investment trusts and manages portfolios of real estate investments. This company's been out a while, since 73. So this is a nice REIT, monthly dividend paying stock, and like I said, they have commercial properties, which is great. So I added American Water and BIPC back to my watch list for swing trade. WPC was already on my watch list, as we see it there. Then I got the top 3 Swan stops for 2021. So these are the plays that you want to get into for a Swan stop. And this is a Healthcare Trust of America, HTA. It was beaten down over the past year due to the pandemic as well. So it's got about a 20-something% growth left in this stock. Nice dividend payer, 4.59%. 79% buy rating from 14 different analysts. Third quarter EPS was great. And this is a real estate company out of Arizona, so you're going to get that monthly paying dividend. And it's basically a real estate investment trust, and owns, operates, and invests in medical office buildings. So huge market there. Guaranteed income. So that's going to be a REIT that has healthcare office buildings. Then we got HIW. This is Highwood Properties. This is going to be a new swing trade for myself. It's also beat down very much. Back in March, it dropped 20%. So it's still got a lot of nice upside on the bounce back. Nice dividend payout of 4.84%. 67% buy rating from 12 analysts. And they've just been murdering EPS since quarter 4 of 2019. And this is a real estate company out of North Carolina. It engages in operations, acquisitions, and development of office properties. It has markets in Atlanta, Greensburg, Memphis, Nashville, Orlando, Pittsburgh, Richmond, and Tampa. This company's been around since 78. So this is another REIT that operates. Basically, it has office properties. So definitely a great dividend stock there, monthly payout. And then my favorite REIT of all time is Realty Income, ticker O. I'm currently down in this position, 2.02%, but that's okay. It's been beaten down since the pandemic. It's got a nice upside of about, I would say about 15-16% or so. And it pays a nice dividend, monthly dividend. Dividend yield is 4.51%. 53% buy rating, 47% hold from 17 analysts. Basically, it provides a reliable, slow-growing monthly dividend built on steadily performing underlying portfolio through various market conditions. With reasonable leverage and amplified liquidity, Realty Income should have the financial flexibility to take advantage of any attractive investment opportunities that become available. Realty's operating history, defined underwriting criteria, and expanding the portfolio and transparency, which should give shareholders comfort while also maintaining management accountability. Realty Income's been killing EPS as well since quarter 4 of 2019, and this is a real estate company out of California. I swing traded this back in July, so I left my gains in the market back in August, and they engage in generating dependable monthly cash dividends from a consistent and predictable level of cash flow from its operations. It operates by the founder, William E. Clark. This is a company that's been around since 1969, and like I said, this is my favorite REIT. Nice dividend, great cash flow. They're always expanding their their portfolio. So here we added the HTA, we added HIW, and then we added back PSTH. Now we're gonna get into the EV plays. This is gonna be a nice EV play. This is something I've swing traded heavy this month. I actually got a buy that's pending the purchase on January 2nd. So this is going to be a great EV play here. And this is a blank check company, so it's going to merge in the EV space. Then we have some battery boost. Demand for electric vehicles batteries will superb a group of metals. So these are the metals needed to build these batteries. So you always want to have some kind of exposure to precious metals, or companies like MP Materials, who go out and get these metals that are needed for these batteries. So you got nickel, aluminum, iron, graphite, copper, lithium, cobalt, manganese. So just take a look at these metals. Do some research, find out what companies besides MP Materials actually acquire these metals, and then that's something you want to invest in, because the demand growth over the next 11 years is going to be huge. Then I got here the top grossing automakers in the world, which is Tesla, of course. Then you got Volkswagen, BMW, Mercedes, Volvo, Audi, Hyundai, Kia, Peugeot, Nissan, Toyota, Porsche, NIO, just to name a few. These are long-term electric vehicle sales projections over the next 7 years, and as you can see, in the millions %, very bullish on EV sales. So EV is a market that's already booming, and it's something that you want to steady invest in, even though price of earnings of Tesla is crazy high. A lot of people will say it's overvalued. Guess what? It still runs up. So like Tesla, your NIOs, those are going to be good investments for long term, even at the current prices. Then you got a global short term and long term EV share of passenger vehicle by regions. And as you can see, we'll look at the long term. As you see, China, Europe, USA, South Korea, Japan, India. So you can see the growth here for these passenger vehicles over these regions. Then you got annual passenger vehicle sales by region, and look how it's just spiking in the millions, guys. This one is just crazy over the long term, which basically means ICE vehicles will be pretty much extinct, eliminated, and no longer produced over a certain amount of time by 2040. So EVs is something you want to get in. You want to think about, EV plays, the charging stations, because you got to charge the cars, who's making these batteries, who's getting the materials to make these batteries, all that types of good stuff. And this is a rendering of the new Apple EV that they're thinking about building. This is going to be super dope. You'll probably be able to get in your car and ask Siri, like, hey Siri, drive me to Walmart, and your car will take you. So along with a whole bunch of other technologies, this is something that I'm pretty excited about, and we'll see what happens with that. Apple's already a great company. They have the most cash on hand out of pretty much any company. They're a super wealthy company, great company. They have a good network, a great universe. Everybody that uses their products, if you have an Apple phone, you probably have an Apple Watch, Apple laptop, Apple everything. So Apple is expanding, and they're gonna do nothing but get bigger. So a great company there. Then we got some of these EV plays, some of these EV car companies. We got BMW. This is something I already own as well. It's only been up 5% in the past year. That was because it was down 13% during the March lows. Currently in BMW, ticker BMWYY, I'm up 28.26%. And BMW does pay a dividend of 2.18%. Very nice PE ratio of 14.76, 53 billion market cap. And basically BMW, they raised their EV manufacturing target by 250,000 units by year 2023. So they're very bullish on making these EVs. And they own brands like Mini Cooper, Rolls Royce, which are premium brands. They possess sustainable competitive advantages, given the strength and global recognitions of these brands, technological leadership in powertrains, and the ability to command premium pricing from their customers that regularly rate its vehicles as some of the best to own, resulting in excess returns. So they can basically charge a premium price. They have a loyal customer base, and their customers love their cars. This is a car company out of Germany. I got in this play around on October the 29th. They do automobiles, and they also do motorcycles. They assemble cars, they sell cars, they have off-road vehicles. Like I said, under the brands BMW, Mini Cooper, and Rolls Royce. And they have some nice motorcycles as well. They also offer credit financing, leasing, and other services to all kinds of retail customers. This company's been around a while, since 1916. I'm pretty sure you all know what BMW is. So that's a nice play there. Then we got Li Auto, something I've been swing trading heavy this month. I swing traded it 2 months ago. Didn't have any luck with it. I got actually purchase due on January 2nd for Li Auto. And this is an EV company, a Chinese EV company as well. And they do smart electric SUVs. It basically provides safe, convenient, and cost-effective mobility solutions to families. So definitely something I'm gonna swing trade. I think it should be on a bounce back. It just IPO'd, earlier, like mid this year. It did run all the way up to like $43 or so per share, $47, and it's down to about $29. I think looking at the technicals, it can get back to that old resistance and actually break that and create a new low. Then we got GM, something I hold long term, something I'm continuing to swing trade as well. Currently on GM, I'm up 38.97%. GM also does pay a dividend yield of 1.83%, and they're up about 12% over the year. They were down 54% during the pandemic, so the upside's still probably about 42% here in this company. Great analyst ratings, and basically GM, they can charge thousands of dollars more per vehicle in the light truck segments. Higher prices with fewer incentive dollars allow GM to get more merge per vehicle, which helps migrate a severe decline in light vehicle sales and falling market shares. Their break-even point of about 10 to 11 million units is drastically lower than the older GM. The company's earnings should grow rapidly as GM becomes more cost-effective. GM's average labor cost is about $5 billion compared to the old GM, which was about $16 billion. So they improved there. They've been doing great EPS as well. I got in this play back on September 4th. They sell cars, truck. They also do automobile parts. They also have a financial company. They have GM North America International. They have Chevrolet, Cadillac, Buick, GMC. They also have the OnStar brands as well. And GM, they sold one of their plants to an EV company. They had a deal with Nikola that fell through. So they're trying to innovate and get in that EV space. So I think this would be a nice play for years to come, in that market. Then we got CIIG. This is something I hold long term, something I'm currently swing trading. I am down on this position 1.41%. But this is going to be a nice bounce back play. It's a new IPO. You know, it ran all the way up to about $37 and then dropped back down, you know, to $27. But it initially started around $9 or $10. So it still has a nice upside at about 30%, in my opinion. And this is an investment service company out of New York. So it's going to be a blank check company. They're actually doing a merge with a rival, which is going to have electric buses, which is going to be super dope. The renderings I saw were for like city buses and things like that. And it's city buses everywhere. So if we can get a small percentage of that market to go with EV from a rival, that's a big revenue. And I'm pretty sure they'll convert to, like, you know, Greyhound, tour buses, school buses, probably RVs in the future. You know, it's all kinds of upside here. And I got in this play around here recently in mid-December on the 14th. Then we have GP, Green Power Company. This is also something I already own. And I'm up pretty good on this company, 158.38%. They do not pay a dividend, but, you know, their charts look pretty good. They're up 33% in the past year. They IPO'd back in August. They took a huge dip of like 60%, and they ran up, sold off, then it ran up again. I like Green Power Motor Company, I really do, and I'm doing well in it, so of course I like them. This is a Canadian company. I got in this, I did a house money swing trade in September. I put $19 into it, and then pulled my $19 out and left my gains in it. And like I said, I'm up over 150%. And they basically engage in the design, manufacturing, and distribution of electric powered vehicles for commercial markets. It offers electric powered school buses, vans, charter buses, and double decker buses. So this is also another play in the EV bus market, along with a rival. Then we got Honda. Me personally, I own a 2018 Civic and a 2015 Honda CBR 600RR. So this is a very, very reliable brand. That's the reason why I did buy a couple Hondas, just for the reliability. You know, it's cost saving. To me, it's a good investment. And my bike's a Repsol, so, you know, I got it no ARP, and I bought it for a less price than the blue book on it. And then with my car, of course, it'll depreciate over value, but I mean, this thing will last me a lifetime. And Honda, they were down like, you know, about almost 10% during the pandemic. They've been running back up, you know, since then. And, you know, it's got probably about a 10% growth left in it. But Honda is just more of a like a reliable company. You know, it's pretty stagnant. It just consolidates all the time. So it's somewhere to put your money that you know it's going to grow slowly for surely over the time. And so, you know, they have a reputation for quality, especially in America's large coastal markets. But management, you know, they're concerned about quality problems in recent years. Honda has slipped in the JD Power rankings. Honda's popular vehicles usually allowed to have fewer incentives than the Detroit 3, which is Dodge, Ford, and GM, boosting the firm's profit and improving the resale value of its vehicles. In 2019, Honda produced about 92% of its vehicles sold in the U.S. and North America. This means Honda is better positioned than Toyota, who only had 68%. So very good for Honda. Quarter 2 EPS in 2021 is expected to be great. Quarter 1, not so great. And this is an automotive company out of Japan. It manufactures and sells automobiles, motorcycles, and power products. You know, Honda has an array of things. They have side-by-sides. They have, you know, leaf blowers. They have all sorts of stuff. So they definitely are, you know, got their hand in a lot of pots. And it's just a nice EV play that I like. I see Honda being very innovative and, you know, taking a nice chunk of that space. Then we got ticker NIU. This is also an EV play. Past year, it's up 226%. EPS has been decent. This is another Chinese stock, and they have basically they do batteries and they do power scooters. So very popular over there in China. You know, it's a lot of crowded people and stuff like that. So, you know, it's kind of probably like similar to New York City. So these lithium-ion batteries and power scooters are going to be, you know, it's going to be a great selling product. So it's something I'm going to, you know, continue to swing trade. Then we got Suzuki, ticker SZKMW. I know Suzuki mostly for their Gixxers and their, you know, their Habusas, but I'm sure they got a lot of different products. This thing was like down 50% during the pandemic, but it's still up 8% over the past year, so it's running back up. They do pay a dividend yield of 1.42%, and they have a massive upside. The 52-week high is 225. It's currently at 186. This is also an automotive company in Japan. It engages in the research, development, design, manufacture, sale, and distribution of motorcycles, passenger vehicles, commercial vehicles, and special machinery. The motorcycles, you know, they have merchandise. They have all-terrain vehicles. They sell mini cars, subpatcom cars. They got standard-sized cars. And they also sell like outboard motors. They do snowmobiles, electro senior vehicles, and this company's been around, you know, for over a century. So great play here, great swing trade, and long-term investment. So that's my my top EV picks, along with some dividend plays, along with some Bitcoin news. If you like the video, please hit the like button, subscribe, hit the bell, follow my journey. I really appreciate you guys tuning in.